Assalamualaikum and hi everyone. Today we are going to present the operating segment reporting of QAFA Limited and the interim financial reporting of QAF Limited. Now, I would like to introduce you guys our team members. Amir Haziq as the CEO of this company, me, Nur Irdina as the executive accountant, Nur Intan as the executive accountant, and Wani Damia as the senior executive accountant. Now, I am going to briefly explain to you guys about our company's background. So, we were formerly known as Jane & Company as a sole proprietorship that established in the 1950, and we were carrying on the business of food trading and distribution. But in 1958, Jane & Company was rebranding its name as QAFA Limited since we already incorporated as private limited company at that time. We were also based in Malaysia. QAFA Limited is engaged in food manufacturing industry with bakery, primary production, and trading and logistics as its core businesses. But this company is currently involved in bakery operations, food trading and distribution, food manufacturing, warehousing and logistics operations, and milk and dairy production. QAFA Limited products includes Cow's Milk, Farmline, Orchard Fresh, Spices and Dorian, Pardina and Gonjor. We are also a holding company for investment. Just like other company, we also have our own mission and vision. So for our vision, we are committed to enhancing shareholder value by pursuing a strategy of long-term sustainable growth and value creation. In this respect, we engage with the communities in which we operate and seek to, amongst others, strengthen our market position and brand equity and expand the operation of our core businesses and distribution networks. For our mission, we encouraging healthy consumption habits among consumers and leading by example in wellness and nutrition education. Our business evolves and seeks to improve to keep pace with the market industry developments. We create positive impact in many ways. By driving innovation, we make concerted efforts to improve the nutrition and quality of our product and develop new products to meet ever-changing consumer demands. So, for our achievement as in 2021, QAFA Limited was honoured with 2 awards, the Malaysia's Best Employers 2021 award in April and the Forbes World's Best Employers 2021 in October. QAFA Limited was ranked number 47 out of 200 companies in the Malaysia's Best Employers 2021. It was ranked number 262 out of 750 companies in the Forbes World's Best Employers 2021. Both awards were based on anonymous employee surveys. Now, I'm going to pass this presentation to Nur Intan to explain more detail about management approach about this company.
Assalamualaikum and good day everyone. My name is Nur Intan binti Abu Naim as the new appointed of Account Executive Team Member of QAFA Limited. Today, I will present the management approach from the perspective of factors to consider having segment reporting. It consists the nature of the business, existence of managers responsible for the activities, and information presented to the board of directors. Without waste time, looking at the first factor is determined by any activity carried out by the entity with the main objective of profit maximization. Looking back at the nature of the business activity, there are 4 factors that must be taken into consideration. Firstly, the nature of the product and services in QAFA Limited include manufactures and distributes bakery and confectionery products, in which each division is offering different products and services to our customer. Nature of the production process, QAFA Limited applied continuous maintenance was carried out for the production processes to improve food safety and quality. Type of class for the products and services may consist of suppliers, business partner, domestic and international parties. Lastly, the distribution method of the product and services. Our company has an extensive food-related operation and distribution network across Asia-Pacific regions. The second factor is each segment will be controlled by the segment manager who are responsible for ensuring the performance of the segment and directly contact with the CEO. In QAFA Limited, since our company is a large manufacturer and distributes bakery and confectionery products, each division will be monitored by a divisional managing director to control the department performing and are reported to the top management on a regular basis. For the third factor, chief of decision maker shall refer to the board of directors in determining each segment and as it consists of valuable information about the overall performance of entities such as financial statement in order to make better decision making. So, the board of directors will be able to make better decision either the segment should be discontinued or replaced with a new segment that can provide more earnings to the company. QAFA Limited has business segment and geographical segment. Business segment and its unit of entity that engage in providing product and services. The core business that was run by QAFA Limited includes bakery, distribution and warehousing, investment, primary production and others. Next, we go to geographical segment. Geographical segment, also a unit of entity that engage in providing product and services but only within a certain economic environment. QAFA Limited has separated geographical segment based on location and region which consists of Malaysia, Singapore and Philippines. Chief of Decision Maker (CODM) of QAFA Limited will be Amir Haziq, who is the representative of the Group Chief Executive Officer (GCEO), and his responsibility is making major corporate decisions, managing the overall operations and resources of company, and develop the strategy of the group for board consideration according to FAR570. Operating segment, the decision making made by the chief of decision maker is an essential item which their main function is to help allocate the resources of the entity. Their decision also have access their performance.
Next, we move to the process for identifying a reportable operating segment and non-reportable segment. According to MFRSA, operating segment, an entity is required to disclose information about a segment separately if it meets any of the following quantitative threshold tests of 10% threshold test and 75% test to identify the qualification of reportable segments. 10% threshold test consists of three bases, which are revenue basis, total profit or loss basis, and the total asset basis, which are meant to pass 10% or more. In this case, QAFA Ltd is using revenue basis to evaluate its segment's performance. Therefore, the 10% threshold test will be evaluated based on its total reported revenue from sales to external customers and inter-segment. After the elimination of reportable segment, the entity must do 75% test rule in which its combining total of external revenue of reportable segment must be passed at least 75% from total of external revenue of entity. To reproduce the segmental report according to the calculation shown by using 10% threshold test of revenue basis, there are only two reportable segments, which are bakery and distribution and warehousing operating segments, by consist of 70.83% and 20.64%. Since investment, primary production and other segments do not pass at 10% threshold test, they will be combined together and disclosed as all other segments category in the segmental report. In order to meet at least 4 reportable segments and 1 non-reportable segment in QAFA Ltd, the new adjustment has been created by adding 2 new segments, which are plantation segments and property segments, as shown in the following table. After the adjustment, QAFA Ltd will have 4 reportable segments and 3 non-reportable segments. After making new adjustment, the new segmental report has been made by using the adjustment of new reporting segment will be changed in reportable status. As per calculation shown by using revenue basis, there are 4 reportable segments stated exceeding 10% combined revenues of QAFA Ltd, consists of bakery, distribution and warehousing, plantation and property segments by 55.23%, 16.1%, 11.75% and 10.28%. Investment, primary production and other segment will be classified as 1 in all other segments as they fail to meet 10% threshold test requirement. However, QAFA Ltd believes the information in non-reportable segment is significant to the users of financial statement by adding all of them as reportable segment to testify by using 75% test, since the company fulfilled the 75% test of 93.36%. Therefore, the company can simply ignore investment, primary production and other segments. Next, I will pass Mr. Amir Haziq for the presenting his next point.
Alright, now we move on to the conclusion of the segment reporting, which is the advantages and disadvantages of segment reporting. For the advantages of segment reporting, it helps in analyzing the company's performance. As we know, segmental reporting refers on every individual segment of a company. We can see either the operating segment in the company are performing well or not. It helps the shareholders to evaluate the company in the current situation based on the company's performance. Next, it helps potential investor in better decision making. Segmental reporting provides investor a complete overview of the firm's operation. They will be aware about the company since segmental reports shows all the details and all the perspective that have been taken consideration by the management. Thus, investor can analyze and make a clear decision on the investment based on the reports. And for the last one of the advantages, it helps to analyze the most profitable or loss-making units. The profit-making and loss-making units can be easily identified in the help of segmental report. It helps the company in deciding on making investment units. For the disadvantages of the segment reporting, it is a time-consuming process. There are many disclosures should be required in the case of segment reporting, so it will take a long time to complete the process. Next, cost of disclosures. Segment reporting involves cost of disclosure. This cost will increase the company's operating costs since the company need to incur more costs to provide additional information. And the last one is the problem of misinterpretations. Segment information might be misleading by the external users such as investors. Operating data by segment are developed for internal management user. As for the external user, it may be hard for them to understand and using them for their investment decision.
Now, I am going to continue this presentation by explaining the basis of the operation of the interim report. QAF Limited had prepared its interim financial report by following all the requirement criteria stated in paragraph 9.22 of the main market listing requirements of Bursa Malaysia Securities Berhad and complies with the requirements needed in MFRS 134, interim reporting and other MFRS issued by the Malaysian Accounting Standard Board. This interim report will be presented together with the group's unaudited annual financial statements for the financial year ended 30th June 2021. Firstly, MFRS 134 interim financial reporting adopts a discrete method as a basis for preparation of the interim report. Secondly, each interim period should be considered as a separate accounting period from the annual cycle. Thirdly, interim reports are meant to predict and describe the financial position and financial performance for the discrete period, which may be a segment of the annual period. And lastly, revenue and expenses items be measured and recognized in the same way that annual financial statements are prepared as per discrete method. Now, Nur Intan is going to continue this presentation by explaining the accounting policies used in preparing the interim report.
Thank you, Ms. Irdina. Next, I will continue the accounting policy used by QAF Limited. The two accounting policies that currently used by QAF Limited can be looked from the perspective of property, plant and equipment and intangible asset. In QAF Limited, property, plant and equipment are stated at cost less accumulated depreciation and impairment loss in accordance with FAR570 property, plant and equipment. Next, for the depreciation is calculated as to write off the cost of other property, plant and equipment on a straight line basis over the expected useful life of the assets concerned. The useful life and depreciation method reviewed in yearly basis with different annual principal rates. And for intangible asset, trademark and intellectual property with finite life are amortized on a straight line basis over their useful life of 20 and 10 years respectively. Software with finite life will commence amortization on a straight line basis over its useful life of 5 years and once it is available for use in accordance with MFRS 138 intangible asset.
As a public limited company, the company encouraged to prepare and publish interim financial reporting in quarterly basis. QAF Ltd has been prepared the condensed interim financial reporting for their company, and the interim financial report has been prepared in semi-annually starting of 1st January 2021. The interim report consists of 6 months and it will be prepared for the first half year and the second half year, which will be ended at the closing date of financial reporting, which is 31st December 2021. Next, the content that should be present in the interim report is including which are all of each headings and subtotals that were included in its more recent annual financial report. Second, the selected explanatory note required by the MFRS 134 interim financial reporting that focus on the significant changes in its financial position since last reporting date. In addition, the company also need to disclose the basic earning per share and diluted earning per share on the face of the statement if the entity present the items of profit or loss in a separate statement. Lastly, the report should also be prepared on a consolidated basis if the most recent annual financial statement was a consolidated statement. As for QAF Ltd, they have been prepared unaudited condensed income statement, unaudited condensed statement of comprehensive income, unaudited condensed statement of financial position, unaudited condensed statement of changes in equity, and also prepared unaudited condensed statement of cash flow in the interim financial reporting. Next, we move to the next presenter is Mr. Amir Haziq.
Thank you, Wani, for your explanation. Right now, we will move on to the period for the current and comparative of each statement prepared by the company. QAF Limited accounting period will end on 31st December each year. The current and comparative periods for each statement prepared by the company according to MFRS 134 interim reporting will be measured from 1st of January 2021 to 30th June 2021. It is equivalent to the first half year interim of QAF Limited in 2021. That means QAF Limited prepares their interim report semi-annually. For the statement of financial position, the reporting periods of 6 months for the current interim starting from the 1st of January 2021 to the 30th of June 2021, while 12 months of reporting periods for the comparative end of the year starting from the 1st of January 2020 to 31st December 2020. For the statement of profit or loss and other comprehensive incomes, the reporting period of 6 months for the current interim starting from the 1st of January 2021 until 30th of June 2021. 6 months for the cumulative year to date from the 1st of July 2021 to the 31st of December 2021. 6 months for the comparative current interim starting from the 1st of January 2020 and 30th June 2020. And the last one is 6 months of comparative year to date starting from the 1st of July 2020 until 31st December 2020. For the statement of change in equity and statement of cash flow, both will have exactly the same reporting period and reporting date. For the cumulative year to date, the reporting periods of 6 months starting from the 1st of January 2021 to the 30th June 2021. While the comparative year to date, the reporting period is 6 months starting from the 1st of January 2020 until 30th June 2020. Next, we have made a few adjustments throughout the analysis in interim reporting in terms of intangible assets. The first adjustment is regarding to trademarks. The cost of trademark on the 1st January 2020 is amounting 2,750,000 Singapore dollar. There is no additional intangible assets being purchased for the year of 2020 and 2021. There is also no disposal of any intangible asset during the year of 2020 and 2021. However, since there is an amortization during the year amounting 68,750 Singapore dollar, there is amortization charge will be deducted against the cost that resulting 2,681,250 Singapore dollar on 30th June 2021. For the second adjustment, it is regarding to the intellectual property. The cost of intellectual property will be increased to $146,000 since there is a gain of currency realignment of $11,000 in 2021 and a loss of $1,000 for 2021. There is an amortization during the year of 2021 amounting $7,300. At the 30th of June 2021, the closing balance of the accumulated amortization amounting to $51,300. The adjusted carrying amount of the intellectual property is $94,700. Last but not least, I show you the extract of the financial statement to show the effect of before and after the adjustment of the intangible assets of trademarks and intellectual property. That's all from us. Thank you.